my name is Christy Hoonervanger Suchateau. I'm a licensed enrolled agent. That means I'm licensed to practice in all 50 states. And I have been an expat tax professional since 2012, living in the Netherlands specifically since 2015. I'm the CEO of BNC Tax and Accounting, and we are the largest local US tax firm here in the Netherlands. Tonight, we are talking about tax planning for retirement while living abroad in the Netherlands. What are the options that are available to you as an American living in the Netherlands? What kinds of things you need to avoid? And then what I think is the most optimum strategy. This is really the most asked question that we get as we're talking to our tax clients. How can I save for retirement? What kind of tax opportunities are available to me? And to be honest, most people just don't know where to start. I do need to make a disclaimer that this is not financial advice. This is not legal advice. The information presented today is intended for educational purposes only, and it is given to you from a tax strategy perspective. But it is important to review the information in the context of your individual situation and to consult with a registered financial advisor or a legal professional, neither of which I am. I am a tax professional. I'm giving you guys a perspective from a tax point of view and not financial advice. The tax implications and retirement planning for Americans living in the Netherlands can get complex, but it is important that we're doing this to secure our financial stability and peace of mind as we get moving into retirement. Expats are really likely to skip retirement planning because they just don't know where to start. Often they hear things, they're told things by friends, colleagues, family about what they should do, shouldn't do. And some of the traditional strategies that we would normally use when we're living in the US can either be counterproductive, restricted, or even just, not a good idea for one reason or another, or not feasible. So I'm going to talk to you specifically about the Dutch tax system, the US tax system, and how we can use the two of them together to come up with a cohesive strategy. An overview of the Dutch pension system. The Dutch pension system is a three-pillar system that consists of a state pension, otherwise called an AOW, which is a basic state pension, sort of like our US Social Security. It's funded through Social Security contributions, which all of us pay if we are working. And those Social Security funds are used to give cost of living type payouts to people as they reach the retirement age. The current average benefit is 1,200 euros net per month, and it is inflation adjusted. So that's obviously going to be a really small portion of your retirement planning, just like it is for people here in the Netherlands. However, usually we as Americans living here are a little bit behind because we didn't start contributing when we were, in our first job. So your benefit is probably a little bit less. You can see what your expected pension benefit is going to be at mijnpensioenoverzicht.nl, which I think I have a link to on the next slide. Everyone's contributing to AOW, everyone, if you're working, and everybody is eligible for AOW when you retire, even if you move back to the US. And I'll talk a little bit about that later on. Occupational pensions is the second pillar, and that is the employer-based pension. Many of these pensions are actually mandatory, depending on what kind of sector you're in. So if you've worked in HoReCa, or if you've worked in like catering restaurant, or if you've worked in fashion or retail, you are probably already contributing to an occupational pension, but also many other service-based employers do fund pensions as well. This is the main bulk of the Dutch pension system. Over 87% of Dutch workers are participating in Dutch occupational pensions. Funny enough, a lot of expats are not. And I see this a lot with my clients because they're skipping it. They've either opted out or their employer just hasn't offered it to them. And lastly, we have private pensions. Private pensions are what an individual sets up themselves, voluntary savings plan, which has some tax advantages or incentives and allows individuals to supplement their income in retirement. They're also able to have a little bit more control over the pension funding that if you have a private pension. Interestingly, there are over 200,000, and this is an old statistics from 2016, so I think it's way higher than that, but I couldn't find a new number. But there are over 200,000 self-employed workers who have no pension at all in the Netherlands, and that is something that the Dutch government has been trying to focus on how to change for a long time, and they don't really have a solution yet. I did talk a little bit about this already, but I'm going to go a little bit deeper on each of these pensions and what they mean for you and whether or not you should be contributing. State AOW, as I mentioned, it's mandatory. The US has a totalization agreement in place with the Netherlands. So that means that if you're living and working in the Netherlands, not on a very temporary basis, you are contributing to AOW as long as you have any income, and you are not going to be contributing to the US Social Security system. That totalization agreement does also mean that you will get credit for the number of years or contribution quarters that you have to have in order to draw out on your pension. So it's not that you are going to lose any credit years on the US side, but having a Dutch AOW or Social Security and a US Social Security means that they will be combined, and probably both of them will have a little haircut when you are drawing down. This is guaranteed income. Even if you are just here for a couple of years and you contribute a little bit, you'll be able to collect it when you retire. It's probably not sufficient alone for retirement income. Very few people can live on this, and it could reduce your US Social Security as well through the windfall elimination provisions. So who's suitable to contribute? Basically everybody. You're probably already contributing. If you go to this little website, mypensioenoverzicht.nl, and put in your Digity, then you'll find out how much you're expected to receive from your AOW when you retire. Second, Dutch occupational pension. And please tell me if you guys, if anybody, if you want to share, if you are contributing, or if you have any question about this, then let me know in the chat. So this is the employer provided pension. This means your employer actually sets this up, or your occupation has set this up. And it's sort of like a US 401k. So you are either you or your employer or both are contributing, and that income is tax deferred. So you do not pay income tax now on the income that goes into this piece of the pension system. And that income is able to grow, until you retire, and then you will be able to draw down from it just like a 401k at some point, and it will be taxed at that point when you're taking the distributions. The advantage here, and this is, I think, one of the most important things to think about, is that employers often match your contributions. That's free money. So if your employer has a matching program, I recommend utilizing it. Okay. And if I have just been a little bit afraid to contribute because you didn't know what the rules were, as long as you contribute not more than your employer, and as long as there's a couple of neat nuanced rules that you may want to run by your tax advisor, but as long as it falls under a similar plan to a US based employer pension plan, which most Dutch pensions do, if you contribute the same amount as your employer, contribute up to that employer match amount, it's just free money. Take it, put it in there. You'll be able to get it back later. It does have to stay until you retire. So this is not a good strategy if you really need the cash, of course. So there's a little bit of risk there. And of course, we always have to talk about currency risk. If there's any idea that you might retire and use a different currency when you retire, then of course there's risk of having some of your income stuck in euros. Suitability. This is a really suitable plan for anybody who has contributions that will be matched by an employer, as I mentioned. And of course, you do need to provide the information about your pension to your US tax advisor, because it probably needs to be reported somewhere on your US tax return, likely as a treaty position against your income, and also likely on your FBAR. If you have pension contributions through work and you haven't claimed a treaty position in the past, you may want to consider going back and looking at your old tax returns. You may be missing something. Private pension third pillar. This is the voluntary pension scheme. The advantage is that, let's say, you contribute the max every year, then you can reduce your current year income by the amount that you contribute, and then you get a tax break. If you're in that 49.5% tax bracket, that can be a pretty significant reduction in taxes. However, it is tax deferred, so that means you will pay tax later on it. And so it's not like you'll never pay tax. You will, and of course, we don't know what the tax rates are going to be in the future. Please note that this kind of pension may be difficult to find a provider to set up. As soon as you tell them that you have US citizenship or US tax residency, then they may not be interested in working with you. I've seen it when people use Dutch nationality and not mention they're American, they get involved in these, and then it can end up that this is a foreign trust for US tax purposes, which has pretty significant reporting consequences, if not also tax liability consequences. Also, management fees are very high on these types of accounts. That can eat away a little bit into your investment. Okay, so who is this suitable for? And this is quite interesting, but it could be suitable for people who have a Dutch spouse or even a joint business. It is possible for a non-US citizen spouse to contribute to a third pillar pension that has nothing to do with the US citizen person. Dutch taxes for married people are filed separately for most items, and one of them is the income tax item. So it is possible that your Dutch spouse could be contributing to this, which would put away some money for the entire household. I see a couple of questions coming in. If you've not contributed to your pension before, can you catch up, or is it a monthly deduction? That's a good question, and I don't know the answer to that question. You can catch up on an annual basis, but I don't know if at least for the private pension, you can do it before the end of the year. And I don't know how it works with employer pensions. You could definitely reach out to your HR and find out. And then I see also the question about the windfall elimination provision. I'm not going to go into too much detail about that tonight because it's a little bit complex for this discussion, but James, I'll send you an email about that. US pension options, we're probably more familiar with these. Social Security is the main backbone of the US pension system. The average current benefit is $1,900 per month. And there are cost of living adjustments for that. We saw some of the biggest in many, many years occur in the last couple of years due to inflation. Employer pensions could be 401k, solo 401k. The thing is, these are only available to US employees. You're not able to contribute as a foreign worker, so probably not going to be an option unless you're on a specific type of secondment or US contract. And then private pensions are the things that we will focus on the most here, things like traditional IRA and Roth IRA. We'll talk about those. I see a question about rolling an existing 401k into an employer pension. No, not really. If you're living abroad, you can't roll it into a Dutch pension. At least I've never seen it. In theory, you could, but I have had clients try this, and Dutch pension providers tend to be like, no, we don't. It can't be done. So no, but you can roll your 401k into a private pension, your own private pension, like a traditional IRA. And you may have to do that at some point if you no longer have a US employer. A traditional IRA is a tax-deferred retirement savings account, which allows you to save for retirement with tax benefits of tax deferral. So your contributions are tax deductible, which reduces your taxable income. And then you have the same exact methodology that we were talking about before, which is tax is not paid out until you start to withdraw on those funds. So in theory, your money has a long time to grow before you're actually paying any tax on it. The biggest drawback for a traditional IRA is that most expats, at least the ones I see, are not paying US tax. Of course, there are many exceptions to that, but if you're contributing to a traditional IRA with the idea that you will reduce your US tax, but you don't actually pay any US tax because either you take foreign earned income exclusion or you have enough foreign tax credit, then reducing your current tax liability in favor of money that's going to get taxed later on withdrawal, not really a smart move. So it is still a good idea for expats who have US source income. And I see this a lot in the first year or the last year that people live abroad. They still have their US source income. They had a W-2 for part of the year. Then they want to contribute to the traditional IRA to reduce their income tax burden for this year. This is a smart strategy, and I'll give you a little tip about what can be done with that later on. Roth IRA is the next option. This is, again, part of the private pension group for US citizens. This is a post-tax savings account, so it allows you to contribute your after-tax income, and then the growth is actually tax-free when you draw it out. You put your money in, it's pre-taxed, it grows and grows and grows. If you keep it there until retirement, then you don't pay any tax on the growth, which is a fabulous benefit. Of course, the contributions to the plan are not tax deductible now, and that also means they're not tax deductible in the Netherlands. I have heard some discussion with amongst tax professionals about whether US plans could be tax deductible in the Netherlands. I'm not going to touch on that today. So if you've heard that, just put it out of your head for today. If there's ever any movement on that, then I'll, do an update someday, ring the bell. But right now, those are not tax deductible because they are pre-tax contributions. They're not tax deductible in the Netherlands, so they're not going to reduce your tax bill. The advantage is that it's tax-free growth. However, it is based on the amount of earned income that you have. You're not allowed to contribute if you don't have any earned income. So if you're using the foreign earned income exclusion and you exclude all of your earned income, you're not going to have any earned income left to contribute to an IRA, to a Roth IRA. If you do have earned income above and beyond the foreign earned income exclusion, or if you use foreign tax credits, you can contribute. So this is really a good and suitable idea for people who are within those income restrictions. And the other thing to note about a Roth IRA is that it does give you some cash flexibility because you can take out your principal that you've put in anytime. You just can't take out the contributions or the growth of the account without penalty. Next is the US-based investment account. So this is not usually talked about as a retirement strategy, but I wanted to put this in here because it does have really specific advantages for expats. So what do I mean here? I just mean opening up a brokerage account, which either you self-manage or you have a manager manage, but there is no tax advantage to it either now or later. There's no deferral. What it does is it gives you the opportunity to buy and sell stocks through, a US based fund, which you can have a little bit more risk or less, whatever works for you in the time of life that you're in. It gives you some more control. They can also have really low fees, and they can allow you to have more flexibility of buying and selling the things that you want to as you rebalance your account. Of course, having US-based investments does come with the currency risk that you're living right now in euros. You need to pull money out. You've got money in US dollars. So you do have some currency risk there. That goes kind of across the board when you are living in a foreign country. Also, another consideration is that if you are self-managing a US investment account, of course, there's a little bit of time. You need to put some effort into understanding that account. You wouldn't want to just do it based on nothing, of course. So the big thing that I want to stress with the US-based investment account has to do with box 3. Americans or anyone living in the Netherlands who's a Dutch tax resident is subject to box 3 tax. Box 3 is changing a bit. We don't know exactly how it's going to change, but I'll talk about how it works right now. Right now, it's a tax on your wealth, and it's a tax on the assumed growth of your wealth on a year-to-year basis. So every year on January 1st, the Netherlands Belastingdienst will look at the value of all of your wealth and determine that it should grow at an assumed rate. So at January 1st, we already know what our box 3 tax is going to be if we're understanding our Dutch taxes. So what we can do is determine how much capital gains we could create with our US-based investment account during the year and sell a certain amount of stock in order to take foreign tax credits against your capital gains. So you use your box 3 in a smart way against your US-based investment account, and then you can buy more stock. So you're constantly increasing your cost basis in your US-based investment account and utilizing foreign tax credits. So over many, many years, this strategy can really work well. Caveat is that the Dutch tax system is probably going to change. We don't know how yet. It may more resemble a tax on realized capital gains, very much like the US system. So you may not know on January 1st in the future what your box 3 tax is going to be, but that's if that does happen, we'll have an even more reason to use a US-based investment account foreign tax credit and rebalance the account. In my opinion, this is a suitable strategy for anyone who's comfortable managing their own US-based investment account and who has box 3 tax to play around with. Another option here is Dutch investment accounts. Dutch investment accounts are the same as US investment accounts. They're just through Dutch financial institutions. You can invest in stocks, you can invest in bonds, you could invest in mutual funds, but you should be a little bit careful about that. It is sometimes challenging to get a Dutch financial institution to give an investment account to Americans, but it does happen. And if you are able to get a Dutch investment account, don't be afraid. It is okay to have a Dutch investment account, but you do need to make sure that you don't get caught up in PFICs, passive foreign investment companies, or types of pooled investments like mutual funds. And the reason is that these are taxed very disadvantageous to Americans. So if you buy an ETF through a US brokerage account, that's great. You don't have any tax problem with that. You can get good capital gains tax rates. But if you buy it through a Dutch investment account, even if it's the same fund, then it could be considered a PFIC. So you can buy stocks. If you get an investment account with ABN AMRO, you can buy Heineken, you can buy Unilever, you can buy single issue stocks without having those PFIC restrictions. So this is, again, suitable for individuals who may want to keep some of their money in euros, who have some risk tolerance and are able to manage their own account, and who are very careful about the types of investments that they buy. Now I'm going to talk about some other out-of-the-box items here. Again, things that are not usually talked about during retirement planning sessions, but this one comes up a lot to me because foreign rental property, we're here in Europe, right? So who doesn't want to have a summer house in Spain? I would if I could, or a winter house, let's say, probably better. So what makes foreign rental property interesting is that you can have both rental income, passive income that is not taxed in the Netherlands. It may be taxed in the country that that the property is in, but it may not be, depends on kind of how the country is taxing this income. So you could have a lucrative source of rental income. You could have a place to go on vacation. You could have property value appreciation over time. And of course, you can have diversification of your portfolio. An interesting item in the Netherlands is that foreign rental property is not taxed. The value is added to your box 3, but then it's also excluded from box 3. So it does not actually cause you to pay more wealth tax in the Netherlands unless you're in a certain high income group. So that is one place that I often see Dutch taxpayers put money is in foreign rental property because it stays out of box 3 taxation if it's not if the property is not in the Netherlands. Okay, so a drawback, of course, there's complexities from local regulations, from dealing with foreign tax implications like VAT on the rental, permits and licenses that you might need. And if it's in another country that's not a European or European country, you could have currency risk as well. By the way, this also applies to US property. That box 3 tax would not apply on property located in the US. So foreign rental property in this context could also mean US rental property. US rental property could be subject to state income taxes as well, depending on what state it's in. This is a good strategy for people who want to diversify their portfolio, who may have a lot of cash sitting around, or who want to get out of some Dutch tax implications. Another interesting item is to pay off your mortgage early. This is, of course, just a simple strategy of making extra payments. Every year, most mortgage providers in the Netherlands allow you to make a certain amount of extra payments without any penalty. And so this can cause you to eliminate the debt before the end of your loan term. This increases your home equity. That can be leveraged if you need it to, if you want to end up getting a home equity line at a later date. But more importantly, for retirement planning, it can reduce your interest payments and it can lead to a debt-free retirement, which we all want, right? A drawback is that right now, a lot of people have secured very low mortgage rates, and extra payments could be getting higher returns if you invest them somewhere else. The stock market has had much higher returns than the average, the recent, at least, average mortgage rates. So, it may not be smart, but it really depends on your mortgage rate. This is good for conservative savers and also people who are already nearing retirement. If you have a high mortgage rate, you're getting closer to retirement and you're looking for a more debt-free retirement, paying off a mortgage early could be a good solution. Okay, I'm going to look back through the questions real quick before we move on and see if I've missed something. Living here a long time, no US income, looking at selling a home for large capital gains. I think this question's a little complicated for here, so I'm going to shoot you an email separate from here. Okay, if I plan to retire in the US, are backdoor Roth contributions worth the box 3 tax implications? Good question. I'm going to talk about my favorite strategy at the end, so we'll talk about that. Okay, so combining the US system and Dutch system, this is what you guys are here for, I think. How are we going to use both to our advantage? In most people's cases, this means diversifying, right? You probably need to have some skin in the game in each system. If you have a Dutch employer, maximizing your contributions that are eligible for a match is a top strategy. If you have US source income and US tax liability that you need to eliminate and can't be eliminated with foreign tax credits, contributing to a traditional IRA can be a really good strategy. If you have earned income above and beyond your foreign earned income exclusion, or if you're using foreign tax credit, Roth IRA can be a great nugget that can help grow your income long-term and have tax-free draws someday. Of course, you do need to have some consideration into how much cash you need to have available at any given time and what contributing into each of those systems means giving up in terms of liquidity, especially if you're considering life changes. So, I've seen it all as a tax advisor. And one of the things that I see is that people think they're going to settle down here for a long time and they start investing in some of these things. And then suddenly something changes. They have an elderly parent in the US they need to go back and care for, or one of their kids decides they want to go to the US and study there and they just don't want to be away long term. And uprooting some of those contributions that you have in the Netherlands can be more challenging and subject to very high tax rates if you want to take any money out of the Netherlands once you've put it in. So you do need to think about the long-term, your long-term strategy. What does it look like if you're going to change your situation over time? And then keep the end goal in mind. Maximizing your retirement income is more important than lowering your tax rate today. So I often hear as a tax advisor, like, how do I get my tax rate as low as possible? And I have seen tax rates, 1.5%. That's fantastic. But really what you want to do is grow your income so that you have the most amount of money available to you when you retire. So don't worry too much about what is my tax rate today and consider what are your investment options that are going to bring you the most retirement income in the future. Okay, so of course, I can't give you exact advice about what you should do, every single person here, because I don't know your situation. I would love to give you that advice, and yeah, you can reach out to me for more information. But what you need to do is to think about each of the options, see what's available and what you should avoid. Like I mentioned, avoid PFICs. They're almost never a good idea for Americans. Avoid opening private Dutch pensions unless you have very specific circumstances, like you're married to a Dutch person and they are going to be the one opening that pension. Avoid contributing to a traditional IRA if you don't have any US tax anyway. And what you can do is just maximize the amount of money that you can get through your employer. Now I'm going to answer one of these questions about the backdoor Roth. So a strategy that I really like to implement with my clients is to take a look at if they have any traditional IRA balances left from the US, how can we get them into a Roth IRA tax-free? Living abroad is one of the only times that you can actually make a tax-free conversion or a backdoor Roth conversion from your traditional to your Roth IRA. And why is it tax-free? When we utilize the foreign earned income exclusion, if we're in an income level that's lower than the current exclusion, you end up with a surplus of exclusion. So what you can actually do is you can convert some of a traditional IRA to a Roth IRA, which is seen as income in the current year. But because of your foreign earned income exclusion combined with your standard deduction, you are able to get some of that income completely tax-free. So you take a contribution that was never taxed and turn it into a contribution that's never going to be taxed. Utilizing that strategy is great if you have a traditional IRA, if you're under foreign earned income exclusion limit currently, and if you are able to open a Roth IRA at this time. The thing is, you do need to know about this ahead of time because you have to do that conversion before April 15th. So you can't do it for 2023 anymore, but you could do it for 2024 at this point. A question that people have about the Roth IRA, is it subject to Box 3 tax? Yes, it is. However, if you think about what Box 3 tax looks like, a lot of it, right now, the exclusion limit's 114,000 euros per couple or 57,000 per individual. So your first 57,000 is completely tax-free. And then a Roth IRA, depending on what you have, what you're doing with the money, if you just have it sitting in cash, it's seen as cash and subject to the lower phantom income rates. If you have it in investments, it is seen as a brokerage account. But the beauty of Box 3 is that you do need to just try to get your investments to actually work harder than the assumed growth of that investment. So when you have some level of control over your investments, like you would in a Roth account, you can make adjustments to things so that you do earn more money than the tax that you pay. Importance of professional advice. I know a lot of this is complex, and it just is. So make sure you talk to a financial advisor and a tax advisor as well, of course, to talk about what is the best solution for you. And review your options regularly. This is a piece of advice that actually struck me when I started doing retirement planning. As you know, I was an American in the Netherlands with zero retirement savings myself, and I heard from somebody, a really great financial advisor, because I didn't know where to start. They said, this can be fluid. You can make adjustments to it as you go. It doesn't have to be that you set up a plan and you're stuck to it forever. You can change things. You can change your brokerage account. You can change your contributions to any of the options available to you. And you can have some fluidity. You just need to start. A couple more questions. Should you talk to a Dutch or American financial advisor? I would recommend talking to an American financial advisor who knows about Dutch taxes. I have a great one, and I will put his contact information in the chat. I've got a couple of them, so I'll put 2 of them in here. It's useful to talk to a US advisor because, you know, the US is always going to be that backstop that even if everything in your life is in the Netherlands, they still have their claws in us from a US perspective. So there's always going to be something to consider on the US side. So I think it is a good idea to talk to a US financial advisor, somebody who understands foreign taxes or foreign income, and Dutch income even better. For ZZP, is there a way to invest in an employer pension? There is not, that I know of. No, there is not. You can convert your ZZP or Eenmanszaak into a BV and set up an employer pension through a BV. I would only recommend doing that if you have other employees and want to have an employer-based pension that way. There's another option I didn't touch on here. It's called a broodfonds. That's a sort of like an emergency fund within your occupation, or it can also be within your town or your neighborhood social organization. It's not actually a pension, but you do pay in sort of like an insurance policy. And if something happens, then you're able to get some money out from that community. So that could be an option for a ZZP person. There could be implications in that as well, FBAR implications, and we would have to understand what they were doing with that investment. So just so you know, that does exist, but it could have US tax implications. Okay, a couple more questions in the chat. Okay, US brokerage firms limiting or closing US citizen accounts does happen. It happens very regularly, and you need to be aware of that. If I just had this happen to a client of mine where it was JP Morgan Chase, they just sold off like several $100,000 worth of stock without warning. So, and with huge capital gains tax implications. So if you're concerned that your financial institution is not going to do business with you if you're abroad, you may consider changing your financial institution. There are options now available for expats. Interactive Brokers is a really good brokerage option. They are specifically for expats, so it's no problem if you live abroad and you invest with them. Wealth management options also exist where you actually have a wealth advisor who holds your funds and manages it for you. And then it doesn't matter if you're abroad, they know that you don't have to use a relative's address. But to answer your question, are there tax issues with using an US address? There are tax implications. The 1099 that you get from your brokerage is going to the IRS, and it's also going to the state that the address that's listed on the document. So if you have a California address and you have never stepped foot in California, California is going to get a copy of your 1099, and they're going to assume that that is subject to California income tax. Now, you don't live in California, so it may not be subject to California income tax, but it's your burden to prove that to the state of California when they come knocking, and they will. I do this all the time, solving this issue for people who get 1099 sent to the state of California. It's usually a few years after the fact. I didn't talk about the contribution limits. You guys can all Google that, but the traditional IRA and Roth IRA have $7,000 per year contribution maximums and $1,000 extra if you're over the age of 50. For box 3 purposes, a CD, is it considered a savings or investment? It's a good question. I actually think it is considered savings, but I would consult with a Dutch tax advisor on that. 403B is not subject to box 3 tax. Is long-term care covered in the Netherlands under normal health insurance? I don't know the answer to that. I'm not an insurance specialist. So yeah, I was going to speculate, but I'm not going to because I don't know. Okay, and I just have a couple of questions that people sent into me that I will answer here just in case they're in here, and otherwise just for a little bit of extra information. What are the tax implications of withdrawing from a US retirement account while living in the Netherlands? Subject to Dutch income tax rates. If you retire in the Netherlands and you start drawing down from your traditional IRA or your 401k, if you still have one, then it will be subject to box 1 in the Netherlands. But if you're retirement age, you get lower income tax rates. So it's not going to be at the 49.5%, almost off the bat. You have a more graduated and lower tax rate when you're older. Just a note as well, if you do draw from your US retirement account before you are of retirement age, US retirement age, you will be subject to the US 10% penalty, even if you live here in the Netherlands. So you do have to be aware that you're going to be subject to seriously high tax rates, because if you're under the retirement age, subject to Dutch tax rates, so it goes to 49.5% after you hit 75,000, and you'll be hit with that 10% penalty back in the US as well. So pretty expensive if you take money out early from US retirement account. What are the benefits and drawbacks of investing in foreign rental property? Okay, I did actually cover that one. So I must have thrown that slide in after I saw that question. And how does the Dutch pension system interact with US Social Security system? Can I receive benefits from both? Yes, so they do have a totalization agreement where you will be contributing only to one system while you're living in the Netherlands. This is actually very interesting that I see it conflated a little bit sometimes. How do I explain it? Okay, if you have US source income that's not being taxed for income tax purposes in the Netherlands, like let's say you're a business owner and you have a LLC in the US that's totally US sourced, you've got a shoe store in the US and it's sitting there brick and mortar, and you have a manager, and all that income is US source income. But for Social Security tax purposes, it actually ends up on your Dutch tax return, and you will pay Dutch Social Security tax on that US source income. But this question was probably more about drawing down. And when you retire, if you have paid into both systems, if you're eligible for both systems, you can draw down from each system. There is a windfall elimination provision within the Social Security systems that makes you, it gives a little haircut to the amount of benefits that you can get from each country if you're receiving benefits from another country. And you can actually call the federal benefits unit in Dublin, and they're very good at giving you a calculation. If you tell them that you have Dutch Social Security income that you're expecting in retirement, they can give you a calculation which will tell you about how much you should expect to receive from the US. It is actually self-reported, and it is your responsibility to inform Social Security that you have a foreign Social Security. They are supposed to be talking to each other. I don't know if they really actually are, but when you do retire, you will actually report to the federal benefits unit how much you're receiving from your non-US Social Security benefits. Implications of currency fluctuation on my retirement savings and income when living abroad. Of course, this is a major topic that you would be talking to with your financial planner. From a tax perspective, there are not really currency fluctuation considerations because we do not consider currency fluctuations income. So if you end up with a big advantage because of currency fluctuations, that does not become taxable income. So there's no tax implication that we need to worry about. But the tax implications that I think about with currency is what happens when you sell something that has a different value in the US because of tax implications. And most often that's property. So rental property, for example, we convert it at the spot rate on the day you bought it, the spot rate on the day you sold it, which are two different rates. And you could have phantom income or a phantom loss in the US depending on the currency fluctuation on that rental property. How much time do you have to work in the Netherlands to access state pension? I believe it's also 40 quarters, but I am not totally positive. So I will double check on that and get back to everyone. Okay, that comes to the end of the Q&A. If I missed your question, I'm so sorry. I will look through the webinar chat after this, and I'll send you an email to anybody who, if I missed your question, I'll try to get back to you. Here is my contact information. I'm from BNC Tax and Accounting. We're local here in the Netherlands. And here's my email, phone number. And if you want to make an appointment, go ahead and click on the appointment link. I'll put it in the chat as well. Thank you guys so much for being here on a super hot night. It was really nice to spend the evening talking about this. I hope you guys got some good information. And if you would like to have any further discussions about your personal situation, do book an appointment. I love chatting with you. I love helping people with this. I think it's very underutilized that people don't think about tax planning now for retirement. And it's something we should all be thinking about while we're living here. So thank you so much. I'll send out the recording and have a good evening.